Well, good morning, everyone. So I guess this is the last panel before the lunch break. So for those of you guys who are still here, really appreciate it. So my name is Lexi. I'm currently the regional lead for Noble in Vietnam and China. Quick introduction about Noble. So Noble is an asset issuance platform purpose-built for stablecoins, and we recently launched our yield-bearing stablecoin USDN pegged with US dollar and fully backed by the US Treasury bills. Our discussion today is titled Accelerating Stablecoin Adoption in Emerging Markets. And over the next 30 minutes, we'll explore not just why stablecoins matter in the developing world, but also what it's going to take to move from early adoption to true mainstream impact. Well, I'd like to invite each of our panelists to briefly introduce about themselves and their projects. Let's start with you.
Hi, everyone. My name is Aviessa. I'm a fintech strategist and the regional director at Kiln. A little bit about Kiln. Kiln is an institutional-grade staking platform. We focus in working with licensed exchanges and as well as crypto treasuries funds. So some backgrounds about myself. I started my career actually in the e-commerce, witnessed the offline to online transitions era for e-commerce and shopping. So I spent most of my time actually in payments. I was in a public listed payment company, Nuvei, so it was the same company as Alice in the last panel. During 2021, they acquired a crypto payment company called Simplex, which is the first fiat on-ramps on Binance. So the founding members at Simplex actually convinced CZ, that will be the mainstream fiat deposit to convert Web2 users into Web3. And everyone started replicating the same strategy. And there is actually a lot of fiat on-ramp during 2017 to 2023. Yeah, today there's actually even more fiat on-ramp solutions in the markets. So thereafter, actually, I moved to a London startup payments company focusing on crypto to expand in APAC. So I brought the on-ramp solutions to most of the exchanges, wallets in APAC region. So in the last 10 months, I moved into staking. So wanted to be a little bit more into DeFi space. But because I spent a lot of time helping the platforms to actually bring users to deposit their fiat into like crypto or stablecoin. So now I want to be in the world where I help them to generate rewards and yield. Yeah, good to be here. Thank you, everyone.
Hi all, my name is Bryan. I'm actually a product and growth manager at WSPN. So for those that don't know, WSPN refers to Worldwide Stablecoin Payment Network. In short, we are the issuers of WUSD, which is a 1:1 back US dollar stablecoin.
Hey everyone, I'm Ralph, Business Development Director at Coins.ph. We're the #1 crypto exchange and payments platform in the Philippines. We recently launched PHPC, the Philippines' first Philippine peso-backed stablecoin, fully licensed, fully regulated, and backed 1:1 by the peso. And we've designed PHPC to simplify, make peso payments fast, borderless, just like sending a message.
Hi everyone, I'm Shina. I'm leading growth at Perena. And Perena is where your money would grow and flow efficiently and securely. Right now we're on Solana, and we're the biggest stablecoin decentralized exchange in Solana. We've provided almost 2 billion of volume of swaps, and then we've also provided and facilitated multiple stablecoin pools on Solana. And now we are looking into how we can further help issuers, help retails and neobanks to make your transaction and make your growth of wealth more efficient. We have our USD Star, which is an aggregation of different stable coins. We also have our new regulated, fully genius appliance stablecoin called USD Prime that is backed by both T-bills, so USA Treasury bills, and cash equivalents. So I'm looking forward to learn more with and from the panelists right here.
Well, thank you all for those introductions. So let's dive into our first discussion topic. So we'll start at the very beginning with the end user. From the consumer side, what are the most common and effective stablecoin use cases you are seeing in emerging markets today, and what's driving the demand for those use cases? Shina, maybe we could start off.
Yeah, sure. There's a lot of use cases, and I think I'll break down into three categories, and which is mainly the function of money. Money is the exchange of value, and in this case, we're seeing cross-border B2B and B2C payments through stablecoins, making it way more efficient, making it faster and cheaper. And if you've been to the previous panel, that's a lot of talk about how stablecoin can be a great alternative to cross-border payments. And then there is a unit of account. And this is talking about you holding stablecoin instead of your own original currency, and that's basically hedging against the inflation, like Turkey, Nigeria, and of course, even in Indonesia, or now in Vietnam, we're experiencing that insane amount of inflation. So holding stablecoin basically means that you don't expose yourself against the inflation. And lastly, and also it's where Perena is super interested in, is the storage of value, how to grow your wealth in a more secured and efficient manner. So if you hold a stablecoin as yield-bearing, for example, Noble Dollar, you're getting T-bill. And similarly for Perena, we're always sourcing the best yielding strategy for people that's holding our assets and holding your assets on Perena. So I would say there is a lot of use cases, but mainly being a better way of transaction of value, being a better way of accounting your unit by holding stablecoin instead of your local currency, and of course, by holding stablecoin and grow your wealth through a safe yielding strategy.
Raf, do you have any more thing to add on that?
Sure. So in countries like the Philippines, the most effective stablecoin use case is remittance. So for context, the Philippines receives about 40 billion US dollars of remittance per year. The main reason being is that a lot of Filipino workers go to foreign countries, get paid in foreign currency, and they have families in the Philippines, so they have to send back some of that money to the Philippines. That's very big, $40 billion market. And right now, these migrant Filipino workers spend about 5 to 10% for remittance costs. Then some of these transfers take about 5 to 7 days to process. That's very slow, and it's also very expensive. And that's what's driving the demand for remittance as a stablecoin use case. With stablecoins, whether it be a USD-backed stablecoin or what have you, transactions can be processed faster, cheaper, cost-efficient, and with more predictability. You won't have to worry which correspondent bank or settlement bank or intermediary bank the transaction is stuck.
I think they more or less covered the kind of key areas. I think something to just add on is really on cross-border. Right now, I think the cross-border scene, we don't need to talk about how big it is. I think everybody knows and understands. I think what would be interesting, especially for emerging markets, is how cross-border can be efficiently brought into light because of all your different merchants, vendors. They're not just sourcing from import-export from a particular area, but a whole jurisdiction or whole region as a whole. So that's something that probably we want to look at how stablecoins can really effectively help them. I would say the other thing that we need to correctly identify is how emerging markets are extremely different from kind of your developed markets already. We have been looking at stablecoins from a developed market lens where this is what we think we'll do best. But are stablecoins actually used to benefit society from a developed market standpoint? I would say yes, but it is marginal. We don't need a stablecoin in a developed market. But actually in emerging markets, you come to emerging markets as a whole, you do see that for day-to-day transactions, for their livelihood, they actually do need it, and it's something that we probably need to touch on a bit more in detail.
Yeah, maybe I will just touch a little bit because I think you guys covered most of it. Maybe for the user's experience. I think for a lot of remittances use cases, especially for emerging market where they want to have preserve in the value, because their local currency, are very volatile. Today it's worth this much, tomorrow it's worth like half less. So they want to hold on to like a US peg stablecoin. And for a lot of this emerging market, people are unbanked, so they mostly don't have a bank account. They might have like a mobile wallet, so probably a user's experience for users to access stablecoin via a local, trusted, compliant, mobile payments wallet will be the good use case.
Well, thank you for all those insights. Now let's turn to the business side of the story. So it's not only consumers, but import-export businesses and B2B platforms are turning to stablecoins as an alternative to traditional banking rails. Why is that happening, and why are the existing banking system not always meeting the needs of these users in emerging markets? Bryan, from your product growth perspective, how do you see it?
This question came out because of the tariffs recently?
Yeah.
Okay. Honestly, I think what we need to address first is why there's this demand, and it comes very much from how we see things on the banking side, on TradFi side. Your current settlements, I think Ralph from Coins.ph actually pointed out, there's a delay, there's a huge spread that's involved. That whole settlement process takes a while. Especially in the import-export business, what is critical for vendors, for merchants, is actually the operating cash flow. And I think a lot of SMEs, especially in the emerging markets, they actually do need this cash flow to spin. So why stablecoins is a potential solution to it is because you have your instant settlements, your transaction cost is literally can be scaled down to as low as possible. They're not paying the 5 to 10% spreads that they're actually covering. Your FX, what we talk about, the store of value, I think is very much giving these merchants, vendors certainty as well, rather than it being fluctuating to their kind of day-to-day markets. So definitely stablecoins, at least to me now, is probably the leading solution to actually address all of this.
Well, Raf, have you seen any similar in your market as well?
Yeah, so I'll just add a bit more to Bryan's answer. So I think the main reason why importers, exporters, and B2Bs are shifting to stablecoins from traditional payment rails is because the traditional payment rail solution that we have right now, I would say, is outdated, especially for emerging markets. So for example, traditional payment rails usually go through SWIFT or operate via a pre-funded model. So if you use SWIFT can be unpredictable. It can go through a lot of correspondent banks or intermediary banks, which add up to the processing time and the cost. Then for pre-funding, that's if you don't have a very big working capital as a payments platform, that can tie up your working capital, and it's also costly. Now the beauty is with stablecoins, you don't need to pre-fund anything. You don't need to really wait on a third party because there's no more middleman when you process a payment via stablecoin. You operate it directly via the blockchain, so it removes a lot of friction when processing payments. Additionally, the main reason why traditional payment rails are not working for emerging markets is because it's very reliant on the dollar. So for example, if you're sending money from an emerging market, say like Nigeria, where they don't really have a lot of dollar liquidity, these banks can't even process payments for you because they want to process the payments via the dollar, then do the conversion onshore in the receiving market. Additionally, if you're sending from an emerging market that's considered as a high-risk country for these banks won't even bother servicing you because they can already capture or service most of the flows in developed markets like, say, the US or the Europe, and they won't bother servicing a high-risk country if it only will contribute to about 5 to 10% incremental flows. So I think that's the main reason why stablecoins are why a lot of businesses are going for stablecoins, because it's unbiased. They don't care if you're operating in a high-risk country, and it removes a lot of friction for the user or the business using it.
Well, thank you, Raf. I want to stick with you for the next question as well. So it's clear that the demand is already there, but we haven't quite reached scale yet. So what do you think needs to happen to accelerate this trend and bring stablecoin adoption to more businesses and consumers in emerging markets?
I think two things. So in order to incentivize adoption of stablecoins, you need to solve two issues. So one is better on and off ramps, aka distribution, And the second would be in real world adoption, aka more use cases for your stablecoin. So on the on and off ramp side, if you want users to use a stablecoin, it needs to be well distributed. Anyone who wants to use stablecoins should be able to buy it in any venue, whether it be via an exchange, whether it be via an OTC, whether it be via a bank, what have you. So unless your stablecoin is well distributed, it won't get good adoption. So just similar to what happened with Tether and Silk Road, right, where they're very well distributed right now. They're one of the pioneers in terms of the first issuers of stablecoins. They're well distributed, so that's why they're getting very good adoption. At the same time, adding to the distribution part, you can also get access to these stablecoins at very cheap fees, very competitive to, say, US dollar. And that's why it's very well used in a lot of markets. The second thing is on the use case. So if you're a stablecoin, if you want adoption, you want to make sure that your stablecoin isn't merely used as a pass-through currency, meaning they on-ramp via your stablecoin, they off-ramp it right away once it's received by your beneficiary. You want to give your users a reason to hold your stablecoin, whether that be via DeFi venues where they can stake the stablecoin or they can do on-chain savings with your stablecoin. Yeah, I think that's the main reason why or how you can grow stablecoin adoption, aka just make sure it's well distributed and there are more use cases than just using it as a pass-through currency.
Okay, thank you, Raf. What about you, Aviessa? What's your take on that?
Yes, I think Raf actually covered a lot on the remittance use cases. For me, maybe I can cover a little bit about use cases for people who are unbanked. So I think unbanked people, they are probably people who work in the factory or in the village. They don't have a bank account, and maybe they have a mobile wallet, but they will never be served by the bank. Like what Raf mentioned, banks actually could serve wider, bigger markets, and why would they actually even serve like a mass market that they don't really make much money out of them? So they will never be able to access to the stock markets or any yield-bearing financial products. So probably stablecoin could be one of the reasons for them to hold on to. Firstly, to preserve the value if they are in emerging markets, and also like a saving account. They can actually earn up to like 5, 10, 20% of what they are holding instead of just idling some cash in their drawer. Yeah, so to have like a better adoptions for these people, I would think that there needs to be a clear regulatory framework, probably like the trusted, local payments wallets like Grab. Everyone's. I mean, I'm stating Grab because we are in APAC, and probably you took a Grab car here, and you know that Grab are licensed in most of the countries in APAC, like the emerging markets. And if Grab could provide a non-crypto native Web2 experience for these people. Because like all the people who are like in the emerging market and with the real use cases, they're not crypto native people. They don't understand what is self-custody. They don't know the difference between all the different kinds of stablecoin, who are the issuer, why there are so many different kind of network, and whether it's safe or not. So they just rely on a trusted platform that they already know. So we abstract away this security, by an app like Grab, and then just to provide them with an incentive. And I think that would be the way to actually move people into adopting stablecoin.
Well, if I may, I want to stay with you for the next question as well, Aviessa. So we've made some progress, but the reality is that most stablecoin tools are still built for crypto-native users or developed markets. What are the biggest product or infrastructure gaps you see, and what are the tools we should be building right now to serve emerging markets better?
Yes, I think it's quite similar to what I mentioned. So I think the Web3 world is a bit more complex to understand. During my time when I was in e-commerce, it's not difficult to actually convert offline people to online shopping because the experience is quite easy to understand. But the Web3 world, there's actually a lot of risk involved. Infrastructure-wise, they don't understand which wallet they need to use, like what is a centralized exchange, what is a Web3 self-custody wallet, and what are the seed phrases. So I spoke to a lot of even like savvy investors who are more in the Web2 TradeFi world. They bought like a Bitcoin to test, like what is a Bitcoin 10 years ago. But like today, they were not able to actually find the seed phrases because they did not understood how important it is to unlock that digital assets. So I would think that the infrastructure needs to be a lot more seamless. Back in my days when I was doing payments, we do a lot of fiat on-ramps for MetaMask, Trust Wallet, Ledger, exchanges. So we have this particular one thing which helps to convert a lot of Web2 users into Web3. It's called the one-click on-ramp. So it's like 15 seconds. You can pay with like a Google Pay, Apple Pay to allow you to just on-ramp seamlessly at a small amount of less than $300 so that you don't have to go through a KYC process. That's actually fully compliant and is accepted by the local regulator that up to a certain amount of on-ramp, we don't have to go through a very clunky experience for the end users. So probably at the start, having some incentive. For instance, if I'm like a platform, I have a lot of end users who are non-crypto native, I'll abstract away the custody, the on-ramp experience, and I need to make the fee as cheap as possible because I'm using this to make a remittance abroad. It's supposed to be faster and cheaper. So if the fee that I'm trying to reduce is 3%, and on the on-ramp fee is already like 3%. So there's no way I want to use a stablecoin to make this remittance transaction. So one way I'm thinking about is, let's say if I'm a platform, I will start like a treasury of my company and put it into like one of the products that you guys have, and then earn like a 5 to 10% a year, and use this additional use to incentivize as a marketing fee to abstract away the on-ramp fee to make it almost like a free for the end user. So it incentivizes for them to on-ramp. Because like back in the day when all these platforms, when they are throwing a lot of rewards, incentive, there's actually a very high conversion rate of Web2 people into Web, like offline to online, but Web2 to Web3.
Well, thank you. Following on what Aviessa just shared, Shina, from your growth point of view, what do you see it?
First of all, Aviessa, I fully onboard your idea. If you want to hold a treasury and get extra yield, we should talk, because Perena is offering that. And second, I hear all the pain points that you talked about. I think by the end of the day, stablecoins are a better alternative of what we are using in terms of money. And stablecoin, in my opinion, is the better money. And to piggyback on your idea of abstraction, we basically want users to use stablecoins without knowing that they are stablecoins. You guys, and even for myself, we don't need to know that we're using USDT or USDC or Perena's USD Prime or is it USDN. They should all be unified with a single layer of liquidity where we plug into neobanks, we plug in with on and off ramp, and they solve the issue with us together on how exactly we'll make the money flow. And on the front end, users should just know that by one click, I'm getting USD dollar equivalent or peso equivalent or Vietnamese dong equivalent, and that's it, right? That's what we want to see people using on the front end. And on the back end, what we as infrastructures of fintech empowered by stablecoins is that we figure out how to make check-ins account for users, which is very, very liquid and fully backed by fiat, and you're able to deposit and then you're able to take out anytime as and when you want. That's your check-ins account. And then there's your savings account. And how are you going to get extra yield? We, under the hood, can get into safe DeFi strategies, or we can buy T-bills, or we can do hedge funding or trading fee strategies. That's very, very complicated. We leave it to our team to handle it. But all as user you need to know is that we give you extra 5 to 10% yield annually if you were to park your money with us. And that will mimic, if not replace, the not working banking system in the emerging markets. So like what I believe we all know that the developing market is facing a lot of financial issues, and the developed market, which are the issuers of stablecoins, might not know a lot about the regional issues. I think it's our mission to understand what's actually happening in the region and learn the pain points and try to solve the pain points together. So TLDR, in conclusion, abstract away the use of stablecoin. You don't even need to know that stablecoin under the hood, and it's our role as stablecoin issuers, as exchanges, or as fintech services that will figure out how to bring checkings account and how to bring savings account to you without actually needing to go to a broken bank.
Well, thank you, Shina. What about you, Bryan? What's your take on that?
I think Shina covered it very well. Something that we have strived, even in our own team, is this concept of invisible tech. So that's the abstraction that you guys have been talking about. Eventually, the future that I actually envision is I'm able to use, say, a Venmo. I'm just transacting from P2P. I'm going to send Aviessa $5. I'm going to send Shina $5. I'm going to send Ralph $5, for example. I don't even need to have that your wallet address, which network I'm going to send into. This should be on the back end of how things are done. Eventually, your user ID, your identity is tagged to just a single wallet. It's the same as how databases function. So technically, with stablecoins, you're just cutting down all the inefficiencies and intermediaries that's in between. Eventually, that's kind of the future I want to see. Something else that I would like to also just touch a bit more upon is how can kind of regulatory framework as well as the government kind of support these initiatives, because what we have talked about is user experience. But on the other flip side of it is, can actually governments or frameworks come in place with the merchant adoption side of things? There is also a reason why users don't use, because merchants might not be providing this service. However, it's a chicken egg problem. If they don't see demand, they won't actually supply. So how can we as an industry, especially at this point where I would say US has taken a lead with all their different laws, policies that's being placed, how can we take it as a step further on a global scale, not just in developed market scale, but emerging markets? I would say that they stand to benefit the most from all these different cost-saving kind of benefits from this.
Well, appreciate that, Bryan. So building on your last point, I'd like to keep this question with you. So in your view, what does the next phase of stablecoin adoption in emerging markets actually look like?
I would say it's going to be very similar to kind of mobile payment or mobile bank accounts that we have. Ideally, what I'm going to see is, hey, I'm able to do payroll, remittance, cross-border, all within a single application itself. And I don't know I'm actually using stablecoins to transact. I think that's where the beauty of it lies. Eventually, what I believe we'll start seeing in the future is how stablecoins will be just managed as digital money. So it won't be anything too different from what we are used to, at least with how we use banking applications. Am I going to apply for a mortgage loan on my mobile application, my bank application itself? Can I actually pay for coffee, or is there then credit or risk stuff that then come on into play? That's how I potentially see the market emerging.
Following on what Bryan just shared, Shina, do you agree with that, or do you see it differently?
Fully agree, 100%, fully support. I do think that regulation clarity is very important, and I think it's a huge booster that the Genius Act for stablecoin has been launched, and we're all very excited. And with that, we also see multiple different stablecoins popping up, because now you can issue your own Genius compliant stablecoins. I just want to piggyback on the idea on regulation clarity, and I think I had a really good conversation with backstage with all our panelists about how are we navigating through the space, and I know that different regulations are being imposed in different regions. I think it is our role, and also it's our challenge to figure out what exactly these compliance are, how do we navigate through it so that we could distribute to all the different countries and our partners in different countries. Because the problem with the current financial structure in terms of payment and in terms of accessibility of money is because there are regulation differences. And we don't want that to be the same bottleneck for stablecoins. Then it defeats the purpose of us even trying to develop stablecoin and solve the issue.
Shina, so let's talk about challenges. So we often talked about the obvious challenges like regulation, user experience, on-ramp, off-ramps, but what's the challenge in emerging markets that you think is underestimated or often overlooked in these conversations?
That's a great question. And honestly, I can't be the expert of talking about emerging market because I take my Singapore citizenship for granted. We have one of the best fintech infrastructure or just financial infrastructure. So me living in Singapore, it's like, okay, I talk about emerging market, like I'm talking bullshit and crap. But I learned a lot from this conference and Conviction that, emerging market, you have your specific needs. For example, in Africa, what I realized when I was talking with Kotani Pay founder is that people in Africa actually holds more stablecoin than they're holding their own African equivalent cash. And the government on the other side, they are holding so much debt that the banking system have to prioritize the government's need when it comes to cross-border payments. So businesses or retail or consumers, they can't access dollars to banks as efficiently as they want to, and that's why they're using stablecoins. And similarly, I think when it comes to Southeast Asia, there will be specific problems in the region that we as stablecoin issuers or stablecoin infrastructure were not really aware of. And I think having the complacency saying that, we are the one who's holding the money, we give you the money, if you don't want it and will not come, is the wrong concept. What we need to know and we should be more targeted and focused on is to come here to talk to the real consumers and the real payment companies to figure out what exactly is your pain point while using stablecoins and how can we solve that together so that you can use my stablecoin, at the same time, I can solve your pain point. And I think that's still a missing gap in the current stablecoin landscape.
What about you, Raf? What would you add as an overlooked challenge?
I think for emerging markets, the most overlooked challenge is the trust in local issuers. So for example, if you're an issuer of USD, which is a very big currency, sure, you can easily get the trust, but if you're issuing a stable coin for a local currency like the PHP or non-USD stable coins, it doesn't work the same way. So that's where it's important to make sure that your stable coins, you have to prove that it's fully reserved, fully regulated, it's redeemable on demand, it won't depeg. And that's where education and transparency becomes very vital. It's not only something good to have, it's essential. Because you want to make sure that everyone who's using your stablecoin feel comfortable and safe that, okay, I will be able to get the exact amount of fiat for this stablecoin if I have to. That's why what we're doing with PHPC, we're making sure that it's fully licensed and regulated. We have proof of reserves, it's fully audited. And we're doing that because without the trust layer, without earning our users' trust, even the best tech won't get used, no matter what stablecoin you have.
Well, thank you, Raf, for the answer. Aviessa, let's turn to you with a slightly different question. So every financial system has its risks, and stablecoins are no exception. What are the ones that worry you most in emerging markets, whether for users or it could be for businesses?
Yeah, so I think for the real use cases in emerging market, I'm always thinking about the Web 2 users more than the Web 3 people because they are less knowledgeable in this space. And there's actually a lot of stablecoins, a lot of network, different issuer, and different ways of generating yield in different stablecoins. There's lending, borrowing, liquid staking. Users are actually unable to tell what's the difference between each of them and the risk involved. For instance, they might not know that putting their money in this lending pool, if tomorrow that lending pool actually disappear, the money will disappear at the same time. So I think the risk involved are a few things, right? First of all, the risk, they don't know what they are getting themselves into. And then secondly, there's also a lot of fraud in this space because it's easy for you to get someone to make the payments to you in stablecoins without any interventions of like a bank's compliance or security check in between. For instance, if you have a bank account and they see like some suspicious transactions, they will actually block it. But in the crypto space, actually, there's not really such a function. If you want to send your crypto across to another person, most likely is you can never get it back. So I think coming back to the user's experience, I would think that a trusted licensed platform for the Web2 users should actually abstract away this risk. Only introduce like institutional grades products that has gone through like a tier 1 auditors, make sure that they also have like a one-to-one reserve pegged to this stablecoin, just to assure that there's transparency, and in any case if something happens, there's insurance coverage or there's actually payout from the wallet or platform in itself. So risk involved is still there, and I think the gap is still quite wide at the moment. But I think in times to come, if we keep focusing on serving the problems for the Web2 users and like addressing these risks involved, I think we can actually like close the gap to get all these Web2 users to have trust and be assured that this is like actually almost as safe as having like a bank's financial services.
All right. Well, I think that's all the time that we have today. I think you are great panelists. Thank you, the audience, for being with us. And special thanks for 98 team for bringing us together on stage. Enjoy the rest of Conviction 2025. Have a wonderful day ahead. Thank you.